In this video, we're going to concentrate a little bit more on portfolios, right? Putting assets together to create an investment vehicle. And we want to look at how does this process affect returns, and more importantly, how does it affect the riskiness of a portfolio? So the percentage of a portfolio's value that's invested in stock, we need to understand what the weight is, right? It's just the percentage of money that you have in stock A relative to all the money that you have invested. And of course, it has to add up to 1, right? So all the money is invested. So how do we find the rate of return on a portfolio? You take the weights, multiply it by returns, and then that will provide us with the, add those all up, will give you the returns. And again, we can do that here on this historical returns. Again, if we scroll down a little bit, we can put our money, 50% of our money in one, 50% of another one. Again, if I make this 20%, now what happens is you see the third asset will come into play. So we have asset A and B, that's that Blandy and Gourmand. And now the stock market return is also here. So again, this will help us to calculate the portfolios with, again, these particular 3 assets. Now let's just say, let's make this 0.75 and make this 0.25. One of the questions that I have for you is it possible, all these weights have to come up to 1, right? But what happens, how do you get your money? I'm trying to figure out how to explain this, but do these weights necessarily mean to be positive? And the answer is no, they don't have to be positive. But you still have to invest all your money. So if a weight is negative, just so I can take some time to explain this, if you have a negative weight, what that means is you have sold that asset and now you have cash. So let's assume in your pocket right now, you have $10,000 and you have a stock that's worth $10,000. If you sell that stock for $10,000, now you really have $20,000 to invest, but you really only started with $10,000. So you could put in then, if we put in, let's put a -5%, whoops, I'm sorry, -5% here, right? So what do we have to put here? We have to put 150% there. And if you see what happens now, 150 plus -50 is our 100. And again, that will then calculate this with now the concept, right, of selling something or borrowing some money and investing. And this is what is referred to as a short sale. And I describe it a little bit in the notes on this slide. But essentially, it's when you sell an asset or borrow money, take that money, add it to the rest of your investment dollars, and invest in the portfolio. So in this case, we have 50% of our money is in Blandy, 50% is in Gourmand. And again, here we have our statistics. 7.8% is our rate of return. 24% is our standard deviation. Now, if you look at this, what happened? 25% is the standard deviation on Blandy. 38% is the standard deviation on Gourmand. But when we combine them together, we get something less, right? So the risk of the portfolio is less than either one of the individual assets in the portfolio. This is what's referred to as diversification, right? So how does that happen? Or what is that process that allows or creates this diversification outcome? Well, so let's think about this. Do the stocks act exactly alike? And if you look here, they have looked at the returns over time for this particular stocks, and you can see that they don't move in perfect lockstep. You can see that when one goes up, the other one goes down, but not as much, right? So it looks like they're sort of related, but they're certainly not perfectly related. So what we need to do is measure this relationship. It's called correlation. It measures the tendency of two variables to seem to act or move together. And of course, we have our Excel formula here, right? So we have it's Correl, and then you have the returns of stock 1, returns of stock 2 in these arrays, and that will calculate correlation. Now, correlation has to be between -1 and +1. So if it's between -1 and +1, can't be any higher. If it's +1, if the correlation was +1, there wouldn't be any change in risk. The risk would not be reduced. So standard deviation is just a weighted average of these two standard deviations, if you will. Anywhere between below +1, you're going to see some diversification. You're going to see some reduction of risk. And it happens regardless of how you put the stocks together. Now, to a varying degree, whether it goes below or not, you're going to see a reduction in a portfolio where the risk itself disappears. So here we have our assets, our three assets. Again, A, B, C, right? A is Blandy, B is Gourmand, and C is the market. And now we see here's the correlation. So the correlation between Blandy and the other stock, the Gourmand, is 0.11. So it's a pretty low correlation. Between Blandy and the stock market is 0.48. Between Gourmand and the stock market is 0.67. So again, all of these things, you can see they're all less than 1. But I mean, not that we need to beat this into the ground all that much, but why are these ones here? Well, what's the relationship between asset A and asset A? They're identical. So it has a positive correlation, right? The covariance is just another statistic that's used to help us calculate correlation. The challenge with covariance is it doesn't really provide us with any, I'm going to use the word power significance, right? We know that correlation has to be less than 1, greater than -1. Covariance doesn't have that stipulation. So again, correlation is what we want to look at. So what happens when we add stocks together? Typically, stocks are going to have a correlation somewhere between 0.2 and 0.7. That changes over time, obviously. But it's obviously less than 1. It's greater than -1, but it's less than 1. So if you add stocks together, as long as the correlations are less than +1, we should see a decrease in the total stock risk or of the portfolio, excuse me. So this is sort of what it looks like graphically, right? So if you chose one company, let's say you went to the New York Stock Exchange, and quite frankly, this is where this study came from. They went to the New York Stock Exchange. They found the average standard deviation of every stock in the New York Stock Exchange. And when they averaged it out, it was a little bit more than 35%. It was pretty close to 40%. So what happens now is we add stocks together. Again, since they are less than 1 correlation, we see that no matter how you add them together, even randomly, you're going to see the total risk decline. Now what happens? As you add more and more stocks together, it continues to go down, but eventually it's going to get to a point where adding more stocks will not dramatically reduce risk anymore. So at a certain point, increasing the number of assets doesn't benefit us by reducing risk more. So how many stocks do you think we should have? Apparently, it looks like down here, somewhere around 40 stocks is the place where you would get the maximum amount of risk reduction. So again, market risk is that part that doesn't go away, right? As you notice, as we get to a certain point, there is a certain amount of market risk in this portfolio that you can't get rid of. No matter how you combine the assets together, no matter how much you add more stocks to this, it's not going to dramatically reduce the risk more. Firm-specific risk is that risk that's disappearing. Again, it's that part of the curve here. This is our diversifiable risk. So standalone risk, as we remember, is standard deviation. Standard deviation or standalone risk is the combination of market risk and firm-specific risk. But now what we know is as we add things together, firm-specific risk is reduced. Now, for the individual stocks, we're not reducing the risk of individual stocks. We're reducing the risk of the portfolio. So as more stocks are added, there's a smaller risk-reducing impact. About 40, that's when it gets to be about the lowest we can get. Now, if we can get well-diversified portfolios, what this is telling us is you can reduce the risk by about half of what it'd be if you owned any one particular stock. So let's ask this question. Can an investor holding one stock earn a return commensurate with its risk? And the answer is no, because total risk has diversifiable risk in it. If you only own one stock, that means you have total risk. Now, what this doesn't mean, though, is that you wouldn't get a return, right? If you were to buy one stock or have one investment, and that investment is P&G, which by most of us would probably agree is a pretty decent investment over time. The question isn't will you make a return, because you will. The question is, does that return compensate you for the amount of risk that you are taking? Again, investors, because we want to eliminate as much risk as we can, you're only going to get paid for assuming market risk. So again, if you only have a few stocks, how many stocks do you think the average person has? If you're investing on your own, it would be rare for a person to have 40 stocks. Typically, 4 or 5 stocks is all they have. They're all stocks that they know what the names of them are. They're very popular, right? But in general, they don't have a well-diversified portfolio. Doesn't mean they're not going to do well return-wise. What it means is that the risk that they're taking, they're not being compensated theoretically. I'll put that in quotes. Theoretically, they're not being compensated for the amount of risk that they're taking on. So again, how do we measure then this market risk? If we can get a well-diversified portfolio, the only risk we're being subjected to is market risk. So we need to have a way of measuring market risk. Standalone risk measures total risk, which is company-specific risk and market risk. But we are only subjected to, we only get paid for taking on market risk. So how can we measure this? There is a statistic, it's called beta. And if you look at the formula, it's the correlation between the two assets, stock I here and the stock market. Multiply that by the risk of I, standard deviation. Divide that by the risk of the market, standard deviation of the market. This will give us the beta. Now, if we're looking in a portfolio, one of the questions we might ask is, how does this stock contribute risk to the portfolio, right? What is its contribution to the overall risk of a well-diversified portfolio? Now, if we only have two stocks, by definition, we really don't have a well-diversified portfolio. But if you take the weight of the asset, multiplied by the riskiness of the stock market, standard deviation of the market, multiplied by the beta of the asset, that will tell you how this asset contributes to the stock on the market risk, right? So how does it contribute to the market risk of the company? So if we use this formula, and I've done this calculation down below, if you invested half of your money in Blandy, what's the contribution to the portfolio? Contribution, as we see down below here, is roughly 15.1%. What is the standard deviation of Gourmage, or what is the contribution of Gourmage? So again, and I didn't complete this calculation, it's beta is 1.30. But when you calculate this, it's not going to be 85% though, so that it shows all of it, right? Because this only measures the contribution to the market risk, not the total risk. And this is only a two-stock portfolio. So again, given the standard deviation of the stock market and the percentage of the portfolio you invest, right, beta measures the impact, right? It helps to measure the influence that the market risk has on the rate of return of the portfolio. So again, that's the end of this video. We're going to continue our discussion in a future video.